Hi, I'm Jimmy. In this video, we're looking at the cash flow statement. So what we're going to do is we're going to go through the basics of the cash flow statement. We're going to look at some individual line items to see what the most important numbers are. Hopefully, we can use this information to help us identify better companies, spot warning signs, and ultimately use the cash flow statement to try to come up with the fair value for different stocks. Okay, now let's jump right in. So this is Microsoft's cash flow statement going back the past few years. This is from the Investors Grow website. And basically, the cash flow statement, no matter what website you use, the cash flow statement is broken into three primary sections. The top section here is the cash from operations. Basically, how much cash has the operations of the business made and lost throughout the year. We'll come back to this. The second section is cash from investing. Cash from investing is things like if the company made investments in other businesses, or perhaps if the company made investments in property, plant, and equipment. So if they bought a new factory, new machines, things like that would land here. Then the final section is cash flow from investing. Cash flow from investing basically looks at what dividends do they pay? Do they pay stock buybacks? If we're curious about the dollar amount that they're investing in these types of activities, do they take out new debt? Well, that type of thing will land here. Okay, now let's look at some of the basics of the cash flow statement. So to come up with the cash flow statement, well, the cash flow statement, they actually derive those numbers from different places from other statements. One, you might notice that with this method, well, net income is actually the top line of the cash flow statement. So you take net income from the income statement and basically you move that on over to the cash flow statement. Now, the point here is that you take the profit of the company and then you make adjustments to net income for non-cash charges. So things that weren't related to cash. One example of that would be depreciation and amortization. On the income statement, depreciation and amortization are non-cash charges that were an expense, but they didn't actually take away any cash during that time period. So you add that back on the cash flow statement. Okay, now we also get a few numbers over from the balance sheet. So let's swap out this second one for the balance sheet. Basically, the first thing to notice here is the date. So in this case, this is Microsoft, and their fiscal year ends at the end of June. But that is essentially, they get that date from the balance sheet. So the balance sheet represents actually two different dates, not a time period. The cash flow statement represents a time period. So on the balance sheet, you have June of 2023 and June of 2024. So because those are the two dates, essentially what the cash flow statement, the date that the cash flow statement is using is for the time period from the first balance sheet date to the second. It covers the entire time period. Whereas on the balance sheet, it is the last day of the month of June, 2023. What was the balances on that day? So for cash, as an example, Microsoft would basically look at their cash balance and write down that exact number. They're not measuring the time period on the balance sheet. They then do it again the following year. We're going to look at why this is important in a second, but just remember that the balance sheet represents an actual date where the cash flow statement represents from one date to the next. So if you're looking at an annual number from one year to the next, throughout that entire year, the cash flow statement is there to represent the cash that flowed throughout that year. Okay, then we come down to our changes in working capital section. All of these numbers come from the balance sheet. And just to illustrate how one would work, they all work the same way. And we'll come to the individual line items in a second. But just to illustrate it real quick, let's look at the change in inventory. So this change of inventory looks at the inventory line on the balance sheet. Now we can see that the name on the cash flow statement is change in inventory. And this is exactly what it sounds like. Basically, we look at what were the inventory, how did the inventory numbers change from one period on the balance sheet to the next period? So in our case, from 2,500 down to about 1,246. How did those numbers change? In this case, inventory dropped down. So that number becomes a positive number on the cash flow statement. Now, the reason for this is that throughout the year, Microsoft would have bought inventory and sold more products and bought more inventory and sold more products. But at the end of the day, because this number dropped, we know that they were able to sell some inventory that they already had on hand. So that is an increase in cash flow because they sold last year's products, essentially. If that inventory number had gone up, well, that would mean that they bought inventory essentially for next year. So that would be a decrease in cash flow. Now, if we were to do the actual math for the 2,500 minus the 1,246, so from one period to the next period on the balance sheet, well, you might do that math and say that number does not exactly equal the number on the cash flow statement. Good point. The number on the cash flow statement is supposed to be the more accurate number. Basically, if we take one and we deduct the other on the balance sheet, that will give us an approximation. But there's some other minor changes that happen in the background that the company has to account for. For example, maybe some currency changes. Maybe if there was a business combination, maybe Microsoft bought a business, and when they bought that business, there would have been an acquisition of inventory. Maybe there were some rounding errors. These numbers are in millions. So really the 2,500 is 25 billion and 25 billion, 2.5 billion. You know what I mean? That number, well, there's going to be some natural rounding errors. So doing the math on the balance sheet, as we've discussed, will give us an approximation, but the number in the cash flow statement is supposed to represent the more accurate number. Now, this is true for all of the numbers within the changes in working capital section, whether it be changes in accounts payable or accounts receivable. Basically, it's all the same. We take those numbers from the balance sheet and we can look at how do they change from one period to the next. Those will impact the cash flow from operations number. Okay, now to get a better understanding of the entire cash flow from operations section, let's jump back to our entire cash flow statement, and we're going to zoom in on the most recent fiscal year. Now, instead of doing it here on a table like this, I think it's simpler if we jump over to the Investors Grow website and look at this same exact information, but this time in a waterfall chart. So the far left green bar is net income. We already looked at that. The cash flow from operations section starts with net income. And then we make adjustments all the way until we get to the first blue bar, which is cash flow from operations. Now, after that, on the website, we continue on and we deduct capital expenditures, which is the red bar. And then we have free cash flow, which is the final one. We're going to ignore those two for now and just focus on the early part of this chart. So we know net income comes from the income statement. Simple enough. Depreciation is actually depreciation and amortization. Basically, we talked about this in our income statement video, but basically depreciation is if a company like Microsoft were to buy, let's say, a machine, and that machine they think is going to last 10 years, and maybe they pay $100,000 for that machine. Well, $10,000 each year would be deducted on the expense, on the income statement. So it would be an expense on the income statement. But since they only laid out that cash in the first year, well, that 10,000 is not an outflow in cash on, let's say, year 5. So assuming this was year 5 on that example item, well, you would have to add that item back, which is why you add back depreciation and amortization. Amortization is essentially the same thing, except depreciation happens for hard assets, buildings, machines, things like that. Amortization happens for intangible assets. Stock-based compensation is exactly what it sounds like. So let's imagine we get hired over at Microsoft. Now, Microsoft is going to pay us $100,000 on an annual basis of normal salary, but to entice us to come over to work at Microsoft, they say we'll also give you, let's say, a $50,000 stock. We'll give you $50,000 worth of stock-based compensation. Now, the way this technically works is the $50,000, there will be a grant date. So we're going to grant it to you, shortly after you get hired, but you don't have the option. You don't actually control the stock for a certain period of time. They call it a vesting period. Let's imagine it's vesting. $50,000 is vesting over 5 years. And maybe each month or each quarter, each year, whatever, some of it vests that it becomes actually yours. Well, the $50,000 is set on the grant date, the date that you're actually granted the stock, but then it is expensed in the expense and the income statement. Is it expensed throughout the, let's say, 5 years? If it was a 5-year vesting period before you completely have all the stock and it's actually yours, throughout that 5 years might, get expensed each month or each quarter, however the setup is for that individual. Well, because again, similar to depreciation, because that's not actually a cash outlay for the company, but it did get deducted in their, on their income statement as an expense, because it reduced net income, well, in theory, you're going to add that back. Okay, now we look at deferred tax. So the way deferred tax comes about is if we think about depreciation, we just looked at that. And we say, okay, in the example, Microsoft bought something worth $100,000, depreciating it over 10 years. But what if the tax rules, let's say the tax rules in the US for that particular item says you have to depreciate it over 5 years or over 20 years, whatever it is, right? Well, the number differences would ultimately create a deferred tax asset or a deferred tax liability because the numbers would slowly be thrown off. And then maybe in the early part, you're paying too much, and then later you pay less. So eventually they all kind of balance out. But this accounts for the fact that in Microsoft's case, this is a negative number. This accounts for the fact that they counted this as income on the income statement, but they never actually received cash. It's something that they've already dealt with previously. Well, because of that, you've got to deduct that at this point. Okay, now we move over to other non cash charges. This, unfortunately, could be a whole ton of things. It could be impairments, it could be one off, it could be gains, unrealized gains on assets or liabilities, unrealized gains or losses. This could be a whole bunch of different things. Now, generally, this number will be fairly small relative to all the other numbers. But if for some reason you happen to see a number that is not small, is, imagine here it was, a $20 billion number. Well, in the financial footnotes of their annual report or quarterly report, whatever numbers we're looking at, in the footnotes, they are required to describe what exactly is in that number. So generally, it's usually smaller numbers like this. We can just kind of ignore them. Or if you're curious, go dig them up on the footnotes. But if it was a big number, they would map it out. But that's where it would be. It'd be real tough right now to say exactly what the number, all the possibilities. There's a ton of things that number could shake out to be. Then we have changes in working capital. Now, we looked at this number before when we were looking at changes in inventory, changes in accounts receivable, accounts payable. We went through that before. Now, in this case, this chart is showing the net number. So we can see that relative to all the other numbers, it wasn't that meaningful. But again, you could find all these numbers as starting and ending points over on the balance sheet. Then that brings us to cash flow from operations. Generally, on the cash flow statement, cash flow from operations is one of the most important numbers because this is the cash that the company is generating. The reason for them being in business is to generate cash. This is where you can find those numbers. Now, before we get into the free cash flow part of this chart, we're actually going to jump to the next section. And this is the investing cash flow from investing section. The reason we jumped over to this is that one of the early numbers here is capital expenditures. Capital expenditures is what the company invests in their own business, in the maintenance and future growth of their business. So let's imagine we have a retail store and we want to open another location. Well, if we were to build another building, well, that building would be a capital expenditure. Maybe in our first location, the roof is falling apart. So we got to replace the roof. Well, that would also be a capital expenditure. Things like that, things that they need to do. You have to replace the roof. You can't have water leaking in there. If you're going to grow the business, you've got to put up a new plant or a new store. Big expenses like that are classified under CapEx, also known as capital expenditures. Now, generally, the way you get to free cash flow, you might notice that not here nor in the cash flow from operations section, free cash flow wasn't there because technically free cash flow is not a US GAAP number. But if you take, roughly speaking, if you take cash flow from operations and you deduct capital expenditures, what it costs to run the business. So how much money, how much cash is a company bringing in? Cash flow from operations. Deduct what it costs them to maintain and, in theory, grow that company. What's left is free cash flow, which can be used for a whole bunch of different things. Then we have acquisitions, net acquisitions. So if Microsoft were to buy a business or sell a business, well, you offset those two. That's why they say net acquisitions. Well, acquisitions is, again, exactly what it sounds like. In this case, Microsoft, this is a huge number for Microsoft. And in the last fiscal year, again, they run June to June. So in the last fiscal year, they actually bought Activision during that time. They paid 60 some odd billion dollars for it. So you can see here where most of that numbers came from. But if you're looking at a cash flow statement, maybe you just started researching a new company and you see a big number like this, you look at this chart and you say, wow, acquisitions is huge. Or maybe it's real green. What did they sell? What did they buy? Things like that. In this case, they bought acquisition, so that is a cash outlay. Okay, then we have the next two. We have investment buys and investment sells. So basically, again, it is fairly self-explanatory. It is exactly what it sounds like. They spend some money and bought some investments. So maybe they buy other stocks, maybe they buy bonds, maybe they're investing their cash in something. And then they sold some. Maybe they had bonds and now those bonds are maturing, or they decided to sell stocks of different companies or whatever they have. They can sell those investments. And this, when they sell it, it's a cash inflow. When they buy it, it's a cash outflow. Then we have other investing. So this is a lot like the other category that we saw in the cash from operations. This could be a whole bunch of different things. And generally, it's going to be a relatively small number. But if it is a big number, we want to find out what that is, and we find it in the footnotes of whatever company we're analyzing. The footnotes will tell us what is within that information, what is in that particular line item. All of that gives us a total of cash flow from investing. Now, this whole section could be very valuable from the standpoint of we always want to know what they're doing with capital expenditures. Generally, imagine a business stopped spending money on capital expenditures. If they stop spending money on capital expenditures, so they stop upgrading their machines, they stop fixing the roof, they stop buying new buildings, well, capital expenditures would fall and free cash flow would look better. But we could see that in the capital expenditures number like, wow, the capital expenditures number has really dropped. That can only go on for so long. Eventually, things need to be repaired. So, one warning sign we can pay attention to is if a company is gradually paying less and less and less for capital expenditures, that's going to come home to roost at some point. That could be a real problem down the line, especially if, let's say, management's bonus is related to increasing free cash flow. That's one way, in theory, you can manipulate free cash flow. Just stop spending money on improvements and growth and things like that. But as you can imagine, for any business, that could be a problem. Okay, now let's jump over to cash flow from finance. So, cash flow from financing is things, you know what? We'll go through each one. It's fairly simple. First one, net cash inflow and outflow, the net number for debt. So basically, a company will sell bonds. Debt, is generally bonds, could be loans, but usually it's something like bonds. Well, those bonds are going to have a maturity date or a due date that they have to pay them off. If they pay off those bonds, well, that would be a cash outflow. If they go out and take on new bonds, that would be a cash inflow. We can see with Microsoft here that they had a slight cash inflow. Now, this is good in the case of Microsoft because we saw in the cash from investing section that they had spent 60 something billion dollars on their acquisition of Activision. But we can see here that debt was actually a slightly positive number, but it was nowhere near the 60 some odd billion that they needed for that. So you knew right away that they had some cash on hand to handle it. Now, I happen to know Microsoft had a ton of cash on hand at that time, so they didn't have to take on additional debt. But again, as we're analyzing a cash flow statement and we're analyzing all three financial statements, the story really comes to light. Everything kind of pieces itself together as we're going through the numbers. Okay, then we have the next two numbers, stock issuance and stock repurchase. So stock issuance is they issue new shares. Really that simple. Perhaps they're issuing new shares. Maybe they're giving employees some shares. They could be doing a lot of things to issue new shares. But then you compare that to stock repurchases. That is the same thing as stock buybacks. A repurchase is a buyback. We can see in this case, Microsoft is spending a lot of money buying back stock. Now, we as investors, if we own shares of Microsoft and they spend big money on repurchases, well, that takes some shares off the plate. So that makes, in theory, our shares worth a bit more. Then we can see next up, we have dividends paid. This is a dollar amount, not per share. This is a dollar amount, total dollar amount. So in the case of Microsoft, they paid about $21 billion out in dividends. So if we're interested in the dividends, well, we look at this, we compare that to their net income, we compare that to their cash flow from operations and say, can they afford to continue to pay dividends? Now, it would be smart to say, can they afford to continue to pay dividends and do the buybacks that they're doing? If they can't afford both combined, well, then something's going to have to give at some point. So in the case of Microsoft, they do cover it. So that's a positive sign. But if you're ever wondering the dollar amount that they're paying out in dividends, then we have other financing cash flows. Now, again, like the other two sections, this could be a whole bunch of different things. If it's a big number, look in the footnotes of the financial statements. They'll tell us exactly what that is. Now, all of that leads to our financing cash flow section. Financing cash flow can be a great spot to again check for dividends. Are they doing buybacks? Where, if we're ever curious and if we can't find that information, this is where it is. And you can compare this to profit. You can compare it to revenue, compare it to EBITDA if you're interested in their debt, things like this. This entire cash flow statement can be very valuable. Now, if you'd like to see me do a video on any one of the individual line items to go a bit deeper on them, I know I kind of blazed through a lot of them, but if you'd like to see more a video on them, please let me know in the comments below. And if you're curious how to analyze stocks, I actually did a video called 8 Steps to Analyze a Stock. I got a link right here, link in the description below. Thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.